All right, welcome to be the market expert. And so, real quick, just want to throw this up on the screen. What you guys are seeing is this infographic, and it's titled "Share of U.S. Mortgages with Negative Equity Rate by Loan Type and Vintage." And so, if we look at this, guys, what you're looking at is it has it right before 2021. There is 2021, 22, 23, 24, 25. Obviously, we understand that when we go back and we look pre-2021, we're looking really at 2019. We're going to call that, your normal market. Then we're going to look at after COVID, post-COVID, right? 2021, when the interest rates were free. 2022, 23, 24, 25. Welcome. Here's where you're at. So as you're looking at this, it's a little bit interesting. So there's all mortgages on this bottom left. And it's going through and it is just dropping that, you know what, hey, 7% of all mortgages in the United States, and right, so someone that has a loan product on their property, 7% are underwater. You look at FHA, 11% of that makes up of it. And then if you go to VA, 33%. So if we look at this underwater really when we're going through is it saying that they owe more than what their current value of their home is. The borrower owes more money to the bank than what their current value of their home is. So if we look at this, I think we got to keep a couple things in mind. Firstly, right, VA and FHA loans typically have lower payments. And your vintages, right? We're talking about years, right? We're talking 21, 2, 3, and 4. Well, what's interesting, if we were to go through this, I think one of the biggest things that we have to keep in mind is that when we're looking at VA and FHA loan products, we consider, right, this lower down payment. And while nothing really has $0 down, there are loan products out there, right? There is these down payment assistance programs. And a lot of these that we look at, they actually have like first-time home buyers that are associated with this. And they have these things called silent seconds, right? Some of them are forgivable and some of them aren't forgivable. And so when you're looking at this, I think this is actually what is driving a lot of this underwater negative equity, if you will. And so when we go through, what we're going to go through and we're going to look at as we're diving into this kind of information, obviously it's FHA and VA. And so these are the people that are going through. They don't have a lot of money down. We understand that home prices are elevated, interest rates are elevated. And so then they're going to go through and they're going to figure out, well, how can I be a homeowner? And they're going to go and they're going to jump into maybe some of these different products. And so I think this is just something that we want to make sure that we're having conversations. When we're looking at this underwater, the next thing that it shifts over to, and we'll look at it, is these homes. So let's dive into this. So check this out. I'm going to switch gears real quick. And let's look at this. So a couple things. I want to do this one right here. All right, so what you guys are looking at right now is here's delinquency rates. All right, so we go underwater. Underwater doesn't mean anything, right? Underwater means, hey, if you were to be forced to sell your home, you're going to be in a situation. All right, that's what this is saying. Hey, if you were to go and had to sell your home, you'd be in a situation. Why? Because your home being sold is not going to cover the expense that you have and the obligations that you have to the mortgage company. And here's the deal. Gary Keller tells us this. The only way that you lose money is if you sell. All right. So we can be underwater all day long unless a life event comes through to force somebody to sell their house. These guys will be okay. We know historically speaking, home prices go up. So now that we look at this, let's take a look at this. And when we go in, and let's just look at like year over year data. It says the total US loan delinquency rate, so loans that are 30 or more days past due, but they're not in the foreclosure. So they got this past due notice. We're down 3%. As a whole, in the United States, we are down. And Colorado, I did look at one of the reports. I didn't want to dive too deep into it, but Colorado is actually one of the lowest top 5 bottom for delinquency rates in the United States. So congratulations. You guys live in a state where we're not going to be seeing a bunch of foreclosures pop up. And again, where we're going to see probably more foreclosures if life event happens, FHA, VA, they don't have equity in their home. So it's not going to be a short sale. It would be more of a foreclosure because they're going to get forced out. And I want everyone to understand that, right? When we look at this, again, you don't lose money unless you sell. So while we talk about we won't see a bunch of foreclosures pop up, is because what happens is it would go to a short sale. The bank forces them to sell their house. They have a lot of equity in their home. And so then they're going to be able to cash out. They're going to pay the bank what they owe them, and they're going to go to the Midwest, right? I mean, that's what this is going to look like, Midwest or maybe Southeast, like not maybe down to Florida, but let's go Alabama, maybe Arkansas, right? Somewhere along those lines. Well, when we're looking at the report that we just looked at, what that's saying is that these FHA and these VA borrowers, they're going to go through and life event happens and they have to sell their home. Well, that turns into a foreclosure at that point, right? Because they don't owe and they don't have enough equity in their home to cover their expenses, and then there's going to be some issues. But if we look at this, we can see as a whole, we're down 3.13%. It says total US foreclosures pre-sale inventory rate, we're up 17%. So they're going through and okay, are we selling some houses because we have equity in them to where maybe we did make some payments to the bank, we lost a job, life event happened, and they go through and now they're being forced out of their homes, but they still have equity. And that's the biggest key in these conversations is, do you have equity? And most Americans do, unless you bought between 22, 23, 24, you're going to have some equity in your home, right? That's when we look at this pre-2021 and go backwards, right? Then we've seen some appreciation at that point. So total foreclosure starts, we're up 30%. Okay, so 30% more year over year, we're seeing people get foreclosed on their house, at least the starting of the process. NED, notice of election demand has happened. All right, doesn't mean that they're going to go to the finish line. It just means like, hey, you missed some payments. We want our money, or we're going to go through this process. But then we go through and we just look at this. We see some downsides. There's a number of properties that are 30 days or more past due, but not in foreclosure. We're down 28%. We go through, it says number of properties that are 90 days or more. We're down 3%. And number of properties in the foreclosure inventory, right? So this is just where we're going through again. And we're seeing some things pop up where people are not making some payments. And again, life events. They only get hurt if there's not enough equity, right? This is a life event that has happened. They lost their job. The spouse that actually had the high paying job was fired. Someone passed away, right? These are the things that are happening, but most Americans have equity in their houses. All right, start off a little doom and gloom, but let's switch this over. Let's be educated. Let's talk about Compass Zillow. So, antitrust, guys. I think this conversation is going to be something that we need to keep in mind because depending on how this thing shakes out, I think our industry changes. All right. So as we're looking at this, Compass Zillow deliver closing arguments and antitrust. This is what this looks like. Compass. Compass has gone through and they say, listen, our listings, our sandbox, we want to play however we want. Zillow pops up. They say, cool. But that means that if you want to play and take your toys and play the way that you want to play, you're not coming and playing in our sandbox. And what I mean by that is that Zillow said, like, hey, listen, if you're going to do private exclusive listings, rock and roll, put it on your platform, do whatever you want to do. But here's the deal. We're going to be scraping data. And if you fail doing a private exclusive listing on your website, which is your right, we at Zillow are not going to ever push that listing for you to try to sell it and help you because you didn't need us in the beginning. Do whatever you want. So it goes through and this is the lawsuit. This is an antitrust lawsuit where Compass has gone through and they said, no, Zillow's picking on us. Essentially, that's what this is. So they go through and they do all these things. And it's antitrust, right? It's competitive because Compass is saying that Zillow's only doing this so that they can sell more leads and they are trying to be punitive and trying to bully us. And this is not in the interest of our consumers. Well, we fast forward and I don't know where this is going to land. And so the judge, right, Judge Vargas came through and through her conversations, it looks like she heard both points. She heard, yeah, like Compass wants to be able to do whatever they want to do. and she heard that it's Zillow's product, so why can't Zillow do what Zillow wants to do? Like it's really like she had some thoughts. And so now what's going to happen is we're going to find out December 5th. December 5th is probably going to be the D-Day on how we see this thing shape up. Now, here's the deal. Compass has gone through and spent a lot of money on their tech. Keep in mind, you're part of one of three companies that owns its own tech platform. Compass owns their own. They bought this company called Contactually back in the day, and that's what they're on. Redfin owns their tech, their platform, and we at Keller Williams own our tech, our platform. We are the only three brokerages in the nation that own our tech stacks. Every other brokerage is pretty much on some other product. And one of the things that we have the ability to do is if this thing goes through, we have the ability to flip a switch. It's literally already baked into our system that says no longer send this information over to the Zillow or MLS. Keep it on Keller Williams' site. Now, this is why we would do this. All right. This is what it boils down to. All right. I think this is what it truly boils down to at the end of the day. Our listing, our lead, our client work with us. And I think that that's what Compass is truly trying to do right now. I don't think this has anything to do with this is the best interest of our clients. I don't necessarily believe that's true, even though part of their argument was like, not every seller wants to sell for the most amount of money. I don't necessarily disagree with it, but I don't wholeheartedly agree with that statement either. And so what happens is if Zillow loses, right? We're going to say Compass wins. Then what this means is that Compass has free reign to do whatever it wants with its toys and its listings and hold it on their platform. Okay, so this is what happens. Zillow holds it on their or I'm sorry, Compass holds it on their platform. They leave it on compass.com or whatever it is. Well, what also happens is that we go through and we do it on ours, kellerwilliams.com. Your guys' platforms, right? Your guys' websites, your guys' platforms. And it doesn't syndicate out. Now, we would have the right to do this. And this is the reason why I think people would, because then it has buyers going directly to the listings. Buyers go directly to the listings. And so then what does that look like? You guys are a part of the largest real estate brokerage in the world. Compass is up there. And then so what you have is there's a lot of smart people out there that are brokerage leaders that are well above my pay grade. This think that at the end of all this shakeout over the next couple of years, we're going to probably have four brokerages nationwide. It's looking like Compass is going to be one of them. Keller Williams is going to be another one. We don't know who the other two would be, right? And that's kind of what they're looking at. And then all the listings live in those four different silos. And then consumers go directly to those listings to go get more information. So we don't know what this truly shakes out to be, but yet this is something that is going to shape policy, and we need to be very, very interested in how this thing goes. You guys are at a good place. Like, I think a bunch of boutique brokerages are probably going to get hurt in this thing. I don't know what this means for the consumer. I don't know if this is a good thing or a bad thing. I don't. I think that it means it's different. I think that it means that there's going to be friction to the process, because then what could it look like? It could look like this. Let's just play this out. And again, this is hypothetical. This is crystal ball. And I don't know if it's working. I don't know if it's on or not. But then I think what it looks like is that you have the four different silos, and the buyer goes through and they identify 123 Main Street. Well, they reach out to brokerage A that has 123 Main Street, and they put in an offer. They don't get 123 Main Street. They're not working with brokerage A. They never signed an agency agreement, or they signed an agency agreement for that one property only. So I think buyer agency looks a little bit different in the future. All right. I think that buyers go directly to the different silos, the different listings. But again, it's hard to tell, right? We don't know what this looks like, but that's kind of what I think the Compass is trying to do with what they're doing right now. So December 5th is D-Day. We'll see what happens. Let's switch this over, guys. You guys are going to be at some dinner tables over the next couple days, right? Over the next month or so, right? We got holidays. You guys are in the season of renewal. And so one of the conversations someone's going to say to you is, how is the real estate market? Or is the real estate market going to change? Or is the real estate market going to get better? And you know what? It does not matter what their question is. Our next question is, hey, to be able to assist you better, to be able to answer your question more informally, do you mind if I ask, are you asking from the perspective of a buyer, a seller, or an investor? All right, that's our next question. Someone asks us a question and we do not give an answer until we know what their state of mind is. Are you asking from the perspective of a buyer, a seller, or an investor? All right. So we go through, we figure that out, and they tell us. Because here's the deal, guys. If you just go through and you're like, oh, yeah, the market sucks, or the market's great, or the market's whatever, well, we've already lost the conversation. They're going to say, awesome. They're going to go do some research without you. So we need to ask them some more questions. So they say, hey, you know what? We're actually thinking about buying, but with these interest rates, we're not super excited. Cool. We're thinking about selling, but we don't think that there's going to be enough buyers out there, and we're going to wait till the spring. Cool. You know what? We actually have a couple extra dollars that we want to invest in the real estate market. I heard that most millionaires are made through real estate. Cool. So what we do is here's a conversation that I think is a safe conversation to have. And it's, hey, right now we do see elevated interest rates in the United States. And it's driven by policy, it's driven by inflation, it's driven by a lot of stuff going on. But here's the deal. We understand that the current Fed president, the Fed chair, Jerome Powell, his term ends in May. Okay, now why does that matter? Well, how is the Fed chair chosen? All right. So the Fed chair is chosen by the President of the United States and then goes through the Senate. Well, if we look through, and guys, so this is the short list, and we don't know how serious this is, but it says that, hey, we got about 5 candidates. All right. So the 5 candidates, this is what we can see. Trump appointed to their first term. We go through and Trump nominee. We go through, I think it says Trump in here somewhere. Yep, Trump administration, advisory. And so when we look through the Fed chair, what it goes through is we would imagine that with the current administration, what we're seeing is that for anyone to be appointed, they're aligned with policy. So when we're talking about, hey, what does the market look like in the next year or so? What we understand that in May, the Jerome Powell will no longer be the sitting Fed chair. He'll still be on the board, but he will not be directly influencing policy as much as he was. Like he's probably going to have something, but not as much as he was. And so whoever comes into that position that's going to be nominated by President Trump is they're going to be aligned with dropping rates. Now, we don't know how quickly this is going to happen. So please, please, please do not say, hey, in May, we're going to get a new Fed president. And with that new Fed president, we're going to see interest rates drop automatically. That's not necessarily the case. We don't understand how quickly it's going to happen. We don't understand how quickly they will be approved by the Senate. And so we don't have any of that information, but we do know that they will be aligned with policy. We just do not know how long it will take to implement. But I do think this is a conversation that we can have. And I think it's a very simple one. It's like, hey, how's the market? Why do you ask? Buyer, seller, investor? Well, starting in May, Jerome Powell will no longer be the Fed chair. He will still be on the board. But we do know the short list is all in line with the president's policy, and the policy is to get interest rates lower. And you know what that means? That we should probably start looking for houses, right? Are you a seller? How are you planning on buying your house? Are you a buyer? How are you finding properties right now? Are you an investor? How are you looking at properties currently, right? And then we go through, we get into relationship, and we get them on our communication. Guys, I think this is a very simple conversation to have because it's not necessarily a crystal ball conversation. We understand that all these people are aligned, and yet we just don't know how quickly it turns on, but I think it gets our foot in the door. All right, we looked at this information. let's do this. I thought this was interesting. I just want to look at these two maps. So here's 2021. It says typical days on market in 2021. If we look at this, we got 30 through 100, right? So 30 days on the market, 100 days on the market. Here's Colorado. You are this smaller square, this lower square right here. And if we look at this, it says like, hey, listen, in 2021 in October, this is what the market looked like. We were somewhere in this 30-ish period. And yes, there were some places that were getting closer to 100 back in 2021, which we're looking at some of these areas and we're like, yeah, I get that. Like, but check this out. 2025, here we are. Again, you are this square. Well, look at this. Let's zoom in a little bit. Well, this is as far as it's going to let me zoom in. All right. So here's Colorado. But guys, check this out. This is where you guys are pretty much doing business. Here's Greeley. Here's Jefferson County. Here's Denver, right? Like this is the areas that you guys are still doing business. And so we are still in this market that, yeah, it's somewhere between 30 and 50 days. And we're seeing that. And yet the conversation as well is, guys, if we price the home appropriately, homes are selling. We're still seeing multiple offer situations. All right. We're seeing a lot of stuff that is happening right now. And so the conversation that we should be having with our people is not necessarily, oh, yeah, the spring market's going to be better. It's that we need to do our research. We need to look at what homes are sitting on the market currently, because that's the competition, not the home that's sold in 2021, not the home that looks similar, that is a zip code over. What homes are in the neighborhood? And that's the conversation, because if we're pricing around that price point and we come in below it, that's what we have to do, right? I know that we got through real estate school and we stopped thinking about the principle of substitution, right? But what we understand though, if we have apples to apples, 3-bed, 2-bath, almost the same finishes, our client's going to choose the cheaper one every time. When we are pricing a home, all we have to do is look. Do the houses look similar? And if they look similar, we only have two different things that we can do. We can either improve it, put money into it to make our house look better, or we can price it accordingly to make it look better from a price perspective to come in lower. That's our only two options. All right. And so as we're looking at this, guys are sitting in the market. Well, yeah, a lot of Colorado's lit up orange. But yet this is where you guys are doing business. Jefferson County, Denver, Greeley, right? Like this is where we're at. And we're less, right? We're 30 to 50 days right now. We're a little bit lighter of a blue right here. Greeley's a little bit better of a market. I actually saw a statistic the other day that said Greeley will actually have more traffic in the next coming years as far as people moving into it, more than Colorado Springs. Now, looking at this map, that actually makes a whole lot of sense. That we're actually seeing that homes in Colorado Springs are sitting, but Greeley's actually starting to move right now. And so I think that when we're looking at that, that might be something we might start thinking about. Do we understand the college town and the different properties? And how do we want to start doing some different marketing over the next couple of years, thinking that this actually might be more of the boom town like Colorado Springs was a couple of years ago. So then I also saw this thing floating around on social media. My buddy actually sent me it on Instagram and it was popping up. And it was talking about how Colorado was one of the worst markets in the United States. Actually, I think it wasn't even one of, I think it was the worst market in the United States to sell a house. And so we look at this is the 105 housing markets with year over year home price declines. And we did make the list. All right. So all this is showing out the 300 top, it's showing the 100 worst. All right. So we're looking at this thing and here we go. And guys, check this out. If we look at this, if we were to start going at least here, it says in May 2024 to May, right? So that's what we're doing 20 year over year, 32%, 36, 36, 35, 35, 35. So we're sitting at this falling market where at least around 35% of all homes year over year this year have been worse than last year. That's the first thing I want to take away. Then we scroll through and we can see this, and we can see Florida, 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 Hawaii, Texas, Florida, Florida, Florida. All right, so Hawaii is the outlier. But if we look at this, we think about the largest land with population, Florida, Texas, California, right? Wyoming's not on this list. And so when we go in here and we look, we understand that these home prices came down because they had big pieces of land. People were moving to these areas. And what we saw big time was these people that were going in and um, that they were building at such a high rate. And since they were building and no one was coming, now they're sitting on inventory. There's a lot of inventory, and now they're having to drop prices. But if we have to go through and we look at this, here is the Denver, Aurora, Lakewood, 3%. 3% decline year over year as far as your home prices falling. So 3% year over year. Now, if we look at this thing, I think this means that there's opportunity for buyers, right? We have opportunity for our buyers. So then we're going through, we're at that dinner conversation, and we're sitting and we're figuring out, are you a buyer, a seller, or investor? And so we're a buyer, a seller, or an investor. And if they're a buyer or an investor, we know that Powell coming through May, term ends, new sitting Fed president coming in, aligned with policy, lowering rates, and we've already seen prices decrease across the board 3%. All right, in Colorado. So then we're going through, we're having the conversation, we're priming it, and we're saying, well, hey, at what interest rate does it make sense for you to become a buyer in 2026? And if we're a seller, right, we're having a conversation with the seller, again, policy, we're seeing lower interest rates, but then we're going through and we're saying that, hey, our biggest thing is that we just need to make sure that we're priced strategically around the competition in the area. Because as I'm looking at this, these numbers lie at the same time. And if I'm in a neighborhood where prices are not dropping or there's not a whole lot of competition in the area, this number does not affect me as a seller. And I've had this conversation with my in-laws, right? My in-laws are moving. They're moving to a different state. And every time a new house pops on the market, my father-in-law sends it to me. And he says, OMG, what does this mean for my property? Not a whole lot, because guess what? This home's on the market today. It's going to be sold before we actually list your property. So it actually has no impact on your house whatsoever. The only homes that have an impact on your home are the homes that are for sale today. We're not looking 3 months back. We're not looking a year back unless there's nothing on the market. Then we can kind of look at some things and change it. But the only conversations that we need to be having is, what does your home look like versus the competition in the area today? Let's switch it over. Let's look at Logan Motoshami, lead analyst for Housing Wire, Friday. Total pending home sales reach multi-year high with mortgage rates near 6%. Guys, here's the deal. We talked about the golden handcuffs for a very, very long time about how our sellers were not going to sell because when they were buyers, they got locked in at 3% interest rates. But guess what? Motivations. The shift book tells us, right? It's all about finding the motivated in this market. People got to buy, people got to sell because of life events happening. And so we are sitting at 6% interest rates, and people are buying and selling houses. And why? Because life still goes on. It might not be super awesome, but I still got to do it. And we understand that there's contingencies, there are concessions, there are so many different things that are helping people get into homes. So if we look at this thing, it says existing home sales have shown 4 consecutive months of year-over-year growth. 4 consecutive months. As a nation, we've actually been seeing more people buy houses. Okay, cool. So let's go look at this thing. Let's look at total pending home sales. 2025, here we are. And guys, check this out. Easter Bunny, jack-o'-lanterns, right? Historically speaking, during this time, real estate agents go to sleep as jack-o'-lanterns and they wake up as Easter bunnies. And if you're at the brokerage, you would probably believe that right now because of how little people there are. But with that being said, look at this. It's not dropping down. It actually came out flat. So week over week, we've been seeing some flatness to where, okay, so it's holding. We're seeing people still buy and sell. Why? Because it is not as seasonal as it was. It's motivationally driven right now. Guys, we were seeing homes sit on the market for 3, 4, 5, 6 months and then multiple offer situations. Why? Why is that? Because it's people coming online. There's something happening in people's worlds that is driving them to make a decision to either buy and or sell real estate. And we don't know what it is, but guess what? It can happen in October, November, December, January, during a snowstorm. It does not matter. This is why we have to be in a relationship right now. It is motivationally driven buying and selling going on right now in the United States. So we go through and we look at pendings. Okay, so we saw it uptick and then dropped a little bit, but this is the thing. It's not down. When we look at the graphs, we have to understand that this is not a downward trend. What this is this is lower than where it was a week ago, but we're still higher than where we were a year ago. And that's very important as we're looking at these graphs. What we are looking at is year over year data. And yeah, we can look at something versus last week, but that just says that, hey, the right homes did not come on the market for the buyers that were currently in the buying process. Then you got purchase application data. And look at this, guys. Look at this gap. Here's 2024. Here's 2025. Yes, we did see a little bit of a downward trend. Obviously, it makes sense when we also see a downward trend on pendings. And so what this is saying is, hey, you have buyers that are going out, that are raising their hand, that are talking to a lender that's saying, hey, life's happening. I'm thinking about entering into the buyer pool. What do I qualify for? And guys, this is why when you're at the dinner room table, whether it is with your family or Friendsgiving or whatever you're going through over these next couple of weeks, we need to be making sure that we are the real estate economists of choice, having the real estate conversations. When someone asks us about the market, we're going to feed them a little bit of information that we've learned. And then we're going to go through and we're going to figure out what's going on in their world. Because what we need to know is we need to understand what their deficiencies are, right? We're going to go through and we're going to figure out like what is having them ask us about real estate outside of real estate being an exciting conversation. So we're looking at this decline over last week, but we're still over last year. People are getting more comfortable with 6%, just like the headline says. Hey, guys, multi-year high, even with interest rates at 6%. Interest rates are at 6%, and they're not much different than last year, but people are more comfortable with them, and life events are happening. We're not going to talk about the 10-year yield. We're not going to talk about the treasury, but let's look at inventory. Guys, here we are. We're going to come over 2019 before this thing ends. All right. Remember, 2019 is an important mile marker because normal housing market. 2020, pandemic, 2021, super low interest rates, 2022, interest rates went up very, very quickly, the fastest they've ever gone up in our history. And then 23, 24, 25, they pretty much stayed elevated. So we have not had a super normal market. And yet when we look at this, we're having inventory hit. So again, why is this a good thing? Well, we understand that prices are coming down automatically because of seller fatigue. We have more inventory on the market. We know that sellers are comfortable doing concessions. What are we doing to educate our buyers on how can they win in this market? But then we go through new listing data. We're right in the mix, right? We're looking at 22, 23, 24, 25, nothing super drastic. We'll see what happens if we follow 2024, if we're closer to 23, 22 in the next couple weeks. Your price cut percentage. Guys, as we're looking at this thing, 41%. If we were to go back in the past, what we understood that most homes, historically speaking, take a price cut, at least 1/3 of them. Right now, we're sitting at 41%. 41% of all homes nationwide are taking a price cut. Why? Motivated sellers. Motivated sellers are looking to get their home off the market to go to their next chapter, right? Their next season of life. And so when we're going through, I think that one of the important things is if a home is a little bit more expensive, maybe a little bit outside of our buyer's price point, what we have to understand is these people that have their home on the market are motivated. Maybe not super motivated, not maybe 10% motivated for a low ball offer, but I think it's worth reaching out and figuring out like, hey, is there a win-win for your seller if we were to put in an offer? I understand we're probably not going to ask what you're offering, but is there other mechanisms that we can put in place to make this feel better for your seller, right? We're going through because 41% of all homes are taking a price cut right now. So this is talking about this week, right? Because this is the week that we're in. This data came out Friday. It says now the government is operational again. We can expect several reports this week. So what we're going to see is, are people buying stuff? right? We're going to go through and we're going to see if people are buying stuff. We're going to see if people still have jobs. It says that they're going to go through. It says the bond and stock markets can sometimes be quiet or quite volatile during this short holiday week because, again, we're seeing people buy, we're seeing people sell, and we're going to see retailers going through and saying, hey, how was Black Friday? And if Black Friday sales were down, it's going to spook some people and we're going to see some volatility going up and down. But let's look at mortgage rates. And so I just went from November 1st to November 25th. And if we're looking at this thing, guys, I like how this looks. It's pretty flat. Pretty flat is solid, right? When we start seeing the roller coaster going up and down, that spooks our people. Our sellers don't want to sell because they don't know what interest rates are going to look like 30 days, 60 days, 90 days from now, depending on when their home sells. And we have buyers trying to time the market, right? So we have these two different things that are happening. So when we see this kind of flat like this, I don't super love this. But for the rest of this, I'm not mad at it. Like I'm actually okay with this because this is not giving anyone any crazy ideas of, I got to wait for the next market downturn, or we might be in this peak right now and I want to wait for the next valley, right? This is what we want to see. We're going to start to see flat. We live in the United States of America. We should be able to guesstimate what interest rates are going to look like over the next 30, 60, 90 days. This is very good. This actually gives our people, our buyers, our sellers, some resolve when it comes into thinking about is now a good time because interest rates aren't popping up and down. But again, Black Friday might actually spike this thing one way or another, depending on what happens with Black Friday sales for some of these retailers.